Hello and welcome to this 10th episode of Investing Not Rocket Science. In the first episode, I defined a basic portfolio framework. The objective of this portfolio is to beat inflation and an equity index. The value of this investment is a million US dollars, and I'm looking to invest into equities and bonds. I plan to actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the investment universe that I'm looking at are the developed and the emerging markets. The benchmark to this portfolio is the ACWI Investable Market Index. From episodes 2 to 5, I added Google, Emerson, and Infineon to this portfolio. In episode 6, I evaluated government bonds and I shortlisted the UK gilts. There was a portfolio update, following which, in episode 7, I shortlisted BMW from the automotive stocks. And uh, in episodes 8 and 9, I looked at European and US financials. I added Deutsche Bank to the portfolio. And from the US financials, I looked at Citi. Um, However, a portfolio decision is something that I'm going to make after this evaluation. In today's episode, I'm looking to evaluate Asian financial stocks. And the stocks that I'm looking at today are the Sumitomo Mitsui Trust Holding, which is a Japanese financial stock. ICBC and Postal Savings Bank are Chinese financial stocks. ICICI and HDFC are Indian financial stocks, and Westpac is an Australian banking stock. All right. Company financials. In terms of annual revenue to market cap, HDFC Bank is at the highest at about 9, probably making it one of the most expensive stocks among these. ICICI and Westpac are between 4.5 to 5.5, whereas Sumitomo Mitsui and ICBC and Postal Savings Bank of China are between 1.4 to 1.8 times. Okay. Net interest income is around 60% of the interest income on loans for most banks. Westpac is leading the way with at about 74%, and Sumitomo Mitsui is the lowest at about 41%. Okay, ICBC has the highest earnings yield at about 24.2%, followed by the Postal Savings Bank of China at 18%. ICICI and HDFC have very low earnings yield between 4.8 and 5.3%. Okay, let's look at efficiency and valuation. In terms of price to tangible book value, um, ICICI and HDFC are expensive at about 3 to 3.4, while ICBC is the lowest at about zero point 0.4, followed by Postal Savings Bank of China at zero point 0.5 and Sumitomo Mitsui at about zero point 0.7. PEG ratio is positive for all and is the lowest for ICBC and the Postal Savings Bank. Return on assets, again, it's a little higher than the European and US counterparts, primarily because of the interest rate scenario or interest rate cycle in these respective countries. In terms of operating income margin, ICBC is the highest at about 56.6%, followed closely by HDFC at about 54.9%, and followed by Westpac at about 49.3%. Sumitomo Mitsui is the lowest, has the lowest operating income margin at about 20%. Okay, let's look at some trends in the financials. In terms of revenue growth, the trends are quite similar. I think the most stable trend here is by HDFC Bank, which has kept the revenue growth quite stable despite an economic downturn during the COVID crisis. In terms of net interest income and non interest income, they're largely flat for all banks, with some variation for ICBC in the non interest income. Once again, we see relative stability in operating income margin as well, quite stable for HDFC, and I see a rising trend here for ICICI Bank since 2018. Okay, provision for loan losses is once again largely flat and has some sort of a downward trend, which is a good thing. Highest for the provision for loan losses is quite high for ICBC compared to its size. Mind you, this stock could be compared to JP Morgan. It has similar revenues. However, JP Morgan does not have these numbers for its provision for loan losses. In fact, it's about one third of this. So, from this perspective, this could be a concern for ICBC. However, another point of view could be that the worst is probably behind them with the real estate crisis, and these provisions for loan losses may reduce over time, but that remains to be seen. All right, fair value and upside potential. In terms of fair value and upside potential on the two methods that I've looked at, which is the analyst target and the comps fair value using Investing Pro, I see that ICBC is and the Postal Savings Bank of China are the two most attractive stocks, has the most, on an average, has the most potential upside from its current value. Okay, on the charts, looking at a comparative performance from the year 2000, you see that ICICI and HDFC have far outperformed its peers in this group, in this evaluation. And ICBC and Postal Savings Bank of China have the least comparative performance. All right, so from this analysis, I would think that ICBC probably comes out as a clear winner, in my opinion. However, there is a concern about provision for loan losses being high, although it is trending lower. And if I were to look at, from the last analysis of the US financials, I shortlisted Citi. I think I'm going to add both Citi and ICBC to a small extent into the investment portfolio, while I'm going to add Sumitomo Mitsui, Westpac, ICICI, HDFC, and Postal Savings Bank of China into the watch list to come back to them at a later point in time. Okay, so that was the end of this analysis. In the next video, I'm going to have a portfolio update and do a quick market catch up in terms of the economic news and the impact that it can have on this portfolio. All right. This is Investing Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Please visit our website for the full disclaimer in terms of use. We can connect on any of our social media channels. You can be a part of our subscriber list on the website, or you can follow us on any of our social media accounts. Thank you for watching, and I look forward to seeing you in the next video. Bye bye.